A lot of the analysis has focused, as you know, Mr. Secretary, which is, strong signal from the administration on the buybacks. But, the fundamentals are ultimately what is going to prevail here in the bond market. And the fundamentals are hard to ignore when it comes to the size of our debt, with public debt increasing to now $40 trillion.
Yeah, I mean, look, Sarah, there's nothing magic about the 40 trillion number, and we can grow our way out of that. So, but what we do want to signal is I think that there's been a lot of misinformation in terms of what's going on with the deficit, what's going on with the deficit to GDP. We actually had a fiscal consolidation for the calendar year 2025. We were at about 5.7% of GDP. And one of the things that's temporary here that's influencing the deficit has been these tariff refunds. And we won't have to do that again.
So do you think we've seen peak deficit during this administration?
I think a very, very good chance we have.
That was Treasury Secretary Scott Bessent on our show here yesterday, discussing the deficit as momentum from his bond buyback operation does fizzle for now in the market. Our next guest says the plan likely will not help bring down yields in the longer term. Let's bring in Rosenberg Research founder, President David Rosenberg. What do you make of all this, David?
Well, I think there's a lot of merit to what Scott Bessent had to say in terms of the deficit peaking. Because most of the fiscal goodies in the One Big Beautiful Bill are in the rearview mirror, and now the government is raking in a lot of tariff revenues after a period post-Supreme Court where that was put on hold. So I have no problem with that. I would just say, though, with regard to the commentary about that this is all about fiscal policy and $40 trillion of debt, that's not why bond yields had been going up over the course of the past few months. I mean, it was just back in late February that the 10-year Treasury note yield was trading below 4%. And it's not as if since February that fiscal policy has really changed. I mean, the three changes has been the war. That's had an impact on the risk premium in bonds. We also have a new Fed chairman who, as we saw at the last meeting at the podium, didn't seem willing or able to answer questions about how the Fed intends on getting inflation down to 2%. So that's embedded another level of uncertainty. And you don't want to own duration when you have that level of uncertainty where the central bank chairman can't answer that question. But the really big issue that's happened in the past several months has not been about fiscal issuance. It's been about the surge in long-dated issuance by the hyperscalers.
Right.
That's what's taken the bid. That is what is the chart of new long-dated issuance from AI-related spending. Now that these 3 of the 4 hyperscalers are free cash flow negative, they're having to go to the capital markets now. That's been the change. And that's competing for the government for funds at the long end of the curve, because that's where these hyperscalers have been funding their large-scale spending
Given
programs.
all that, David, then would you still be betting against long-term treasuries now, knowing that you're fighting the Treasury Secretary?
I watched your segment with my friend David Zervos, and I would tend to agree with him. I mean, did you want to fight the Fed during those multiple QEs? No, you didn't.
No.
I think Scott. I mean, the $4 billion didn't impress people, but I think that Bessent right now is just testing the waters. I mean, there's $4 trillion of marketable debt out there that is 10 years maturity and more. So I get a sense that if he has to, he'll take out a big bazooka, not unlike what Ben Bernanke did. And then the next question is Kevin Warsh going to be playing ball in terms of what the Fed does in terms of the term structure of its balance sheet? So I think, look, the government has drawn a line in the sand that, that it's not going to allow the 10-year to get to 5%.